So now you know everything you need to know to complete a 1031 exchange. Let's dive deep into these things and start to see some of the pitfalls, some of the ways to avoid those pitfalls, some of the ways to find opportunities within the pitfalls, and how the law is actually applied. We're going to take a look at several different areas. The first one is going to be ownership issues and concerns. Let's talk a little bit about how owner financing can work. We'll talk about, remember we said the reinvestment requirements, so we'll spend some time talking about how to creatively take cash out. Everybody likes the idea of putting money in their pockets without paying tax. And then we'll take a look again at the related parties issues and see where we can come from there. So first of all, let's talk about some ownership issues. There's all sorts of ways to own real estate. And remember, we very specifically said that when you're talking about titling, you want to think about who the taxpayer is for the real estate. Now, corporations, LLCs, partnerships, trusts, all of these animals can own real estate. And when you look at our country, there's huge ones. Coca-Cola, Dr. Pepper, Exxon, GM. They're all corporations, whatever their nature is. Just like Hank's Mortuary Service could be a corporation. The key is in how they are taxed and how the owners are taxed by owning them. It's very easy to see from a large corporation. They have shareholders. The shareholders own the company, but the shareholders do not own the real estate that is owned by the company. So if that company wants to sell a piece of real estate, the corporation has to do the 1031 exchange. Because all of the activity of that real estate is reported on the corporate tax returns. The shareholders get dividends. The shareholders may get statements. But none of the real estate of the activity is reported on their individual return. So who's the taxpayer for the property? The corporation. So the corporation can do the 1031 exchange, but not the individuals. LLCs are very similar to that, and partnerships. Limited liability companies are basically a bridge gap that's been created in between corporate status and sole proprietor status to give individuals some of the liability benefits, some of the accounting benefits of a corporation, and yet the ease and function of a sole proprietor. Again, just like everything else, you want to look at where the real estate activity is being reported. If the LLC is choosing to be taxed as a sole proprietor, it does not file a tax return. So all of the activity of that real estate that's owned by the LLC flows onto the tax return of the individual. That makes the LLC what is called a disregarded entity. Now, by doing so, even if the property is deeded in the name of the LLC, who is the real taxpayer? Where's the activity? The activity is on the individual's tax return. So no matter what name is on the deed, if the LLC is a disregarded entity, the individual is the taxpayer. So in that instance, you literally could sell as the LLC and then purchase as the individual. But if the LLC is an LLC that is chosen to be taxed as a partnership, then all of the activity of the real estate goes onto the tax return that the LLC is filing. So who is the taxpayer? It's the LLC. Who can do the 1031 exchange? The LLC. The same thing is true with partnerships as well. Now, when you say partnership, you want to make sure you know what you're talking about. If you and I get together and we decide to go buy a piece of property together, we may think of ourselves as partners. But if we don't have a specific partnership agreement, if the property is not deeded in the partnership, and if the partnership is not filing a separate tax return, then really you and I are just tenants in common. We bought a piece of property together, and that's great. Hopefully we're going to make some money. But if a partnership happens to file its own tax return, then that partnership is the taxpayer. The partners get K1s or partnership returns, but they do not get the activity of the real estate on their individual returns. So who's the taxpayer? The partnership. Who can do the exchange? The partnership, not the partners that own it.